If you're a property investor, I've got a warning for you. There's a ticking time bomb waiting as some high-rise apartment buildings are going to become the slums of the future. As a property investor, you recognise that you've got to own the sort of property that's going to outperform the averages, and many properties in the future are going to underperform because of a shadow hanging over them, and that's the 1 million apartments built over the last decade or 15 years. I'm going to explain a lot more about what I mean and what you can do about it. I'm also going to have a chat with Brett Warren, Director of Metropole Properties in Brisbane, about the research that you should do to help understand what's happening on the ground in property markets. It's the research that we do, and he's going to explain how we do it, what you should look for. And in my mindset moment, I'm going to tell you a story about a Cherokee Indian which has got an interesting message. So at the end of today, you'll know a lot more about property investment, and the Cherokee Indian story will help you have some clarity for your future. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted Australia's leading property investment advisor. That's the 5th time he's won a similar award in the last 7 years.
The way we live in Australia is changing. We're trading backyards for balconies and courtyards, and this has resulted in around 1 in 5 Australians living in an apartment today. That's very different from the 1990s when it was only 1 in 7. So how many apartments are there? Well, interestingly, according to the Australian Bureau of Statistics, of the 10 million dwellings currently in Australia, around 10% of these are what they call attached dwellings, and they've been built in our capital cities over the last 16 years. So we've had so many new apartments, and as you know, many of those were in those high-rise towers. But the trend to medium and high-rise living is only going to increase as more of us are going to want to trade space, having big backyards, for being in the right place. Living close to work, having the right lifestyle and having the amenities. But the problem is that not all apartments are the same. And I see a ticking time bomb for those high-rise apartment buildings, all those 10% of dwellings, so 1 million or so buildings built in the last 16 years in our capital cities. There are some big problems, and you've read about them, you heard about them, but let's go into it in a bit more detail. Because clearly some apartments are going to make good investments. They are going to increase substantially in value over the long term. But in my mind, too many of the high-rise towers built in the last 15, 16 years are going to underperform with poor, if any, capital growth in the foreseeable future. Of course, these Legoland apartment blocks, they never made good investments. They don't offer much scarcity. They've got very little owner-occupier appeal. Most of them have been built with investors in mind. And in the last building boom, it was mainly for overseas investors who didn't really understand how Australians want to live. They didn't understand the needs of the local market. Worse still, because of the high development margins and the marketing costs and the spruikers in the middle of this who got margins as well, too many people who bought into these high-rise buildings paid too much to start with, and they found on completion, when their properties were eventually came to purchase, to complete, I should say, a couple of years after they made the initial purchase, the properties were worth considerably less than the contract price. And the sad reality for these investors is that today, in light of the many media reports of structural problems in some of these high-rise towers, there's now a crisis of confidence, with apartment owners concerned about what unknown issues, what liabilities may lie ahead for them. And of course, potential purchasers are holding back. They're not going to want to buy themselves into future problems. So this sector of the market, the high-rise and the new apartment buildings over 2-3 stories, this segment's lost the trust of the buying public, And this confidence is going to, in my mind, take quite some time to restore as the various stakeholders, including state governments and local governments, the construction industry, building surveyors and certifiers, they're all going to scramble to shore up the building sector. Now, let me say there are some very good builders out there. There are some very proficient developers out there. They've created some good buildings. Having said that, a recent report showed that over 95% of all new buildings have problems. But this is nothing new. They've always had tiny leaks and little problems. But the reports in the media and the unknown future is scaring people off. You see, there tend to be three major types of building issues faced by apartment owners. The big structural defects, these are the ones that grab the headline. But in reality, these major structural issues, they only relate to a small number of buildings. Now, also, there are fire issues. These often relate to inferior cladding used during construction. There have been cladding audits now taken on all around Australia, but one in Victoria found so far 629 affected buildings in Victoria alone are affected by cladding that is flammable, and that's going to cost the owners of those buildings a lot of money. So the three sort of issues that tend to happen are the structural ones, with the cracking that we hear about, the fire cladding ones, and then there are water issues, and boy are these common. They seem to occur to some extent in almost every new building. Things like leaking balconies, leaking showers, roofs leaking, and while these are a nuisance, and they can get expensive, they usually can be rectified. So the fact is, the buildings with the major problems, those requiring mass evacuations, they're the outliers. But for those who are involved in them, boy, are there significant losses, hefty repair bills, uncertainties, unknowns, and no real market for the resale of their apartment buildings or for tenants who want to be moving into them. And I believe some of these buildings are going to be the slums of the future. But that's not all. The standard of high-rise tower construction is a vivid example of how in today's disposable society, the quality of many things is falling in pursuit of bigger profit margins. Now, this is a stark contrast from what was built many years ago, the Art Deco buildings, the 100-year-old buildings that stand proudly next to some of these new towers around our CBD. Even the buildings built in the 50s and 60s and 70s that used to be called flats, they weren't built out of paper mache like the new ones are. They've been built solidly. They were craftsmen built with durable materials, and they've stood the test of time. And some of these older buildings for multiple generations, they're still standing there today, a far cry from the buildings being thrown up in the modern era. But I believe this recent round of disclosures about structural problems in the apartment towers built over the last decade or two is really just the tip of the iceberg. And that's why I'm saying it's a ticking time bomb. You've really got to stay away from this area, no matter what sort of deal you're being offered. You see, it's been suggested the high-profile stories that have hit the media recently are, as I said, just the tip of the iceberg, and many more buildings with structural problems, some big, some small, are going to come to light over the next few years. Now, some developers will have the funds to repair the buildings, but others won't. And insurance often won't come to the rescue of the unfortunate owners, as sometimes it's going to be difficult to know who to blame. Is it the councils who've encouraged high-density development? At times, they've been willing to negotiate their building guidelines, the town planning guidelines a bit, in order to promote development. See, we've had to develop stuff really, really fast. Melbourne's population has grown by over 1 million people in the last decade. Sydney's about over 800,000. Brisbane's well over 500,000. We've had to build a lot quickly. You can't build one-on-one houses as quickly as that. So there've had to be some shortcuts. Developers have often chosen the cheapest buildings to increase profit margins. Builders have been prepared to compromise to win deals. Contractors who may have been willing to cut corners, like importing cladding from overseas because it was cheaper, are now getting caught out. Certifiers who approved the standard of construction, who do you blame? And even when these issues come to light and they are repaired, what rational purchaser is going to want to buy into these buildings? Imagine the owners' corporation costs needed to rectify the works. Imagine the extra insurance premiums required to protect the owners. And the big one, the bank's going to lend to prospective purchasers, even if somebody was brave enough to buy into these buildings. At the same time, which tenants are going to want to move in if there's a chance they may have to evacuate. The trust is gone. And that's why I'm suggesting it's a ticking time bomb. This is going to compound. It's going to get worse. As I see it, there are two tiers of apartments in the future. These issues are going to lead to a flight to quality, meaning well-constructed, medium-density apartments and townhouses will continue to be strongly sought after, and they're the ones who are going to keep increasing in value, and those sort of apartments are going to make great investments. At the same time, tighter future construction standards is going to lead to increased building costs and therefore higher eventual asking prices for the next round of apartments, because we are going to need to build more apartments. And the only way developers are going to be able to afford to do them and build them correctly and get finance to make it happen is by having higher sale prices. That's not going to happen anytime soon. But when it does happen, the next round of development is going to underpin the future value of the already established, solidly built apartments, because the gap's only going to be wider when it's going to cost so much more to build the new apartments. Similarly, the solidly built older established, the 2-3-story walk-up apartments built in the 60s and 70s, as I said before, we used to call them flats when I was young, they've stood the test of time and they're going to continue to make good investments. On the other hand, owners of the poorly constructed high-rise apartments in many of these Legoland buildings built in the last decade or two, they're going to find the value of their properties are going to, at best, languish, but at worst, keep dropping in value. Now, while some of these owners may be able to cut their losses, they're going to find their properties difficult to sell. And many won't be able to, or financially be able to, crystallise their losses, just like many of the unfortunate investors who bought in mining towns during the mining boom. They're still stuck with underperforming properties, which are worth considerably less than they paid for them many years ago. They're stuck and they just can't move forward, and it has forever hampered their financial well-being. So the bottom line, I believe demand for apartments is going to accelerate from a more diverse buyer profile in the future as more of us are using apartments as a preferred lifestyle. It's not just going to be the younger generation leaving home, but also many of the older generation wanting to downsize. So we're going to have to build the right sort of apartments for them, 2 and 3 bedroom, even 4 bedroom apartments for young families. Now, currently the building cycle has reached its peak, so we've reached peak development of new apartments, and it's now emerged that many of the buildings built in the last construction boom, they're going to have a shadow hanging over them for some time. And at the same time, the reluctance from future purchasers is going to make it really hard for the next round of developments to even get sufficient pre-sales to come out of the ground at a time when tighter planning restrictions for apartments, particularly in the suburbs, is going to make worse the undersupply of dwellings for a growing population. So as I said, this is going to create 2 tiers of units moving forward. Solidly built medium-density apartments and townhouses developed by reputable builders, and many of the towers, those that are currently dotting out landscapes that I think are going to become slums of the future. So what can you do about this? Avoid the temptation to buy new or off the plan, which has never worked, and don't be scared of buying apartments. If you lived in Melbourne or Sydney, that's the way more people live. Brisbane is becoming that way more. But if you lived in Paris or London, you wouldn't even be thinking about buying a house. You'd be prepared to buy an apartment because that's the way more and more people want to live. So if you're looking at getting involved in property, there's a number of ways my team at Metropole can help you. Because now that you can see not all apartments are going to make good investments, critical property selection is going to be more important than ever. So why not get the independent team of Metropole on your side to help you? We start off by putting a property strategy together for you to understand where you are, where you want to get to. We've got no properties for sale, but we give you strategic advice, putting a plan together, crystallising what's going to happen in the future. You know exactly what you need to do. And then if you choose to, you can use the buyer's agent at Metropole to help you. So we help our clients grow, protect and pass on their wealth through a range of services. As I said, we give strategic advice. We build strategic plans. We bring your future into the present so you can do something about it. Our buyer's agency has been involved in over $3 billion worth of property transactions, but we've got our own on-the-ground teams in Melbourne, Sydney and Brisbane that bring you years of experience, years of perspective. That's something money can't buy. And our wealth advisory services can provide you with strategic, tailored financial planning and wealth advice. And of course, our property management division can help you in the long term, as can our renovations and development teams help manufacture some capital growth. Lots of ways we could help you, but our services don't suit everybody. So why not find out what we could do for you? Go to metropole.com.au, find out about what we could do. I'd love to have my team and me be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today's mindset message is short and sharp, but was very impressive to me when I heard it. So I'd like to read this little parable to you as well. And it's the story about an old Cherokee Indian chief teaching his grandson about life. And what he said is, "My son, life is a battle between the two wolves inside of us all. One is evil. He's angry. Envy, sorrow, regret, greed, arrogance, self-pity, guilt, resentment, inferiority, lies, false pride, superiority, self-doubt, and ego." And the Cherokee Indian went on to tell his grandson, "And the other wolf inside you is good. He is joy, peace, love, hope, serenity, humility, kindness, benevolence, empathy, generosity, truth, compassion, and faith. This same fight is going on inside you and inside every other person too," he said to his grandson. And the grandson thought about it for a minute, and then he asked his grandfather, "Which wolf will win?" And here's the answer from the old wise chief Cherokee. He said, "The wolf that you feed." So which of the two wolves playing the battle inside your head is going to win? The evil one, the negative one, the glass half empty one, the one that's looking for problems, or the good one, the joyful one, the glass half full one, the one that's positive? Which wolf is going to win your battle? Let me answer that right now. The one that you feed. People often ask us, what research do you do? What does your research team and your buyers agents do to understand what's happening in the local market? Because there's lots of information you can get on the internet. There's lots of reports that come out. But I believe by having on-the-ground team that have been purchasing properties, buying, selling properties, not selling now in their days of Metropole, but prior to that, all our buyers agents were actually selling agents. What do they know? What perspective are they bringing, and how are they keeping up to date? That's the sort of thing most investors want to know. I bet that's the sort of thing you'd like to know so that it can make you a better investor. So today I'm going to have a chat with my business partner, Director of Metropole Properties in Brisbane, Brett Warren. Hi, Brett.
Hi, Michael. Good to be with you.
Well, clearly the market has moved and the market has changed. And I know that most people look at that by reading in the papers or on the internet what's happened with auction clearance rates or median prices. But I know we dig in a little bit deeper. So let's start off with the common things that people look for, and then let's give people a peek behind the curtain at what our team are looking for.
Sure.
So what's the first thing most investors, home buyers, are looking at?
Yeah, look, most home buyers, investors, they're probably looking and following median house prices and auction clearance rates and things like that. We often find that they're probably more of a lagging indicator, Michael, because there's 3 or 4 months there that the data needs to be collected and published and things like that. So we probably drill down a little deeper and, in fact, get more involved in the asking prices, which is more, real time. We can follow that and get a handle on if people are asking for more or discounting their properties and get a real feel for the market that way.
Sure. So median prices are very much a lagging indicator because what's reported often has been sold 30, 60, sometimes 90 days earlier. Auction clearance rates are giving you a pretty good indication of the sentiment, but that's only really for Melbourne and Sydney, because in Brisbane there aren't as many auctions. In the other capital cities there aren't. So it's not a really good indicator of what's going on the ground. But yes, asking prices, which are a good indicator of the sentiment and the mood of vendors and their selling agents, who nowadays have to be more accurate with the asking range they're giving, has actually been shown to be a very good indicator of what's going to happen in the future. It's a leading indicator of what the sale prices are going to be down the track, because Dr. Andrew Wilson, who regularly reports these on our monthly Property Insider market updates, actually has followed through and seen how asking prices correlate with selling prices down the track. And there is a very, very close indication. So that's what most people look at. What do your team, not just in Brisbane, but in Melbourne and Sydney, also look for, Brett?
Yeah, so there's a number of other key factors. And again, it's drilling down into that level of detail. And Michael, these aren't things we just look at once every 2 or 3 months. We're consistently looking at these each day and analysing every single day the market. So the next one we would look at would be the stock on the market. And, this time of year compared to last time of year in Brisbane and probably around most of Australia, we're probably down about 10 or 12% on this time last year.
And that's because sellers are going on strike. They were worried about why sell in a market where actually I can't buy again. Because remember, we tend to think as investors, but most people in the property market are home buyers. And so buyers are sellers and sellers are buyers. And if they can't see an opportunity of buying something else, they've gone on strike. But they're starting to come back a bit. So, Brett, what are you looking for when you're looking at stock on market?
Yeah, we're looking at a couple of things, and depending on which part of the market we're searching for. But with houses and things like that, as I said before, we're down about 10 or 12% on last year. So we're looking in areas where there's a lot of demand for those kinds of properties, but supply is quite low. And that's a good indication that there's going to be a misbalance and people are going to, I guess, pay a premium because in some cases they keep missing out. They're not getting the property they want, so they readjust their expectations. And if there's not enough stock there, that's going to drive prices further as well.
Well, clearly there's currently a flight to quality. People are nervous. People aren't totally certain what's going to be happening, even though the market's starting to look a lot better. Definitely, if they're looking in the apartment market, they're worried about all the structural problems. So people, in the boom, they just wanted to get in. There was the fear of missing out. They'd buy on main roads and secondary properties. But you're right, Brett, there's a shortage of A-grade homes and investment-grade properties, and they're the only sort of properties we look for clients. What other indicators are you looking at?
Time on market's an important one as well, especially when you've identified the kind of locations that are investment grade and the properties in the areas that are investment grade. Time on market's really important. If you start to see that shortening up significantly, that's usually a good sign that the market's heating up as well.
What you mean from time on market, of course, is how long it takes for a property to sell from when it's first listed until when it's either sold by private sale or auction. And during the slump phases, it dragged out. And every month in my property update, market update, where I go through each state and what's going on, I compare time on market this month to last year. And interestingly, it has been widening. It has been getting longer. It has been taking longer to sell properties. On the other hand, when the time on market starts to reduce, it's a sign that the market is heating up and there are more buyers than sellers. It's actually a good indication of what's going to happen ahead.
Also on time on market, Michael, it's interesting to note the locations, but it's also a good factor to look at for a certain property. So if a buyer's agent, when we're doing our research, comes to me and tells me the property's been on the market for 100 or 200 days when the average is about 30, the first question I'd be asking is what's wrong with the property. If the average is 30 and we're here, 3 or 4 months later, it hasn't sold. So yes, we can look at the overall bigger picture of location, but you can also use that to break it down into the specific property as well.
Makes a lot of sense. What else do you look at, Brett?
Vendor discounting is another one, Michael. So that the amount at which people are either discounting their property to meet the market, or in a hot market, is the sale price higher or similar, so discounting is another important factor that you need to drill down into the detail.
That gives you a good indication of the heat on the market. Now, in general, vendors always put their properties on the market for higher than they expect to get. That's just the way the game is played. But how much they have to drop the price by is an indication of the buyer to seller ratio. And that all ties in with what we said a moment ago, the level of stock on the market and the time on market. These are all things that we look at to get an on-the-ground perspective, but that's one element of it. And you can do a lot of that research on the internet. You then actually have to be on the ground, go to the open for inspections, be speaking to the agents, see what's happening, get a feel of the pulse of the market, Brett.
Absolutely. It's all perspective. And, you can get all these things right, but then end up buying in the wrong location, because just like where you live and where I live, Michael, there's a great part of the suburb, and there might be a lower lying or a secondary area in the suburb. And quite often inexperienced people that aren't experienced in that market really can't distinguish the difference.
That's one of the things we're seeing at the moment with a lot of these younger, inexperienced buyers agents who are, I call them enthusiastic amateurs, and they're well-meaning, but they don't have the perspective. I know you jokingly tell me that they fly in and they bid at auctions and go home thinking they've done their client a favour when it's a property we've discarded because we have the on-the-ground experience.
Look, it's quite amusing. They post on Facebook that they may have got it 50,000 under the median house price, or we've already ruled that property out. It's in a lower lying area, a secondary location, backing onto a main road. It's really about perspective, and that's so important when you're hiring a professional.
Well, one of the other areas that we look at that gives us a perspective of what's going on, it's really important to understand, is the demographics of the market, Brett.
Yeah, absolutely, Michael. Demographics is probably my personal favourite. I really like understanding the makeup of a suburb, and we've quite often talked about the owner-occupier percentage. But in this current economic environment, I really think it's important to drill down a little bit deeper. We're in low wages, low inflation, so there's going to be little growth for wages and inflation over the foreseeable future. So the best way to combat that is to actually target areas and suburbs where wages are actually growing. And drilling down and looking at weekly family income, which we look at quite consistently, and find areas that are growing in 1.5 to 2 times the average. These kinds of people have multiple streams of income. They generally live where the jobs are being created. And just like Sydney and Melbourne, in Brisbane at the moment, it's the airport and the CBDs that are rapidly expanding. And these are the areas where people are coming to with good incomes. They're doing silly things, Michael, like paying $50,000 too much at auction and knocking over their home and gentrifying the suburb and putting another $600,000 home on top. And they're the kind of areas where we like to get involved in, because if you've got the little property tucked around the corner and the streets and areas starting to gentrify, there's value being added without you even lifting a finger.
That makes a lot of sense. So in the coming years, with, as you correctly said, lower wages growth and interest rates can't drop much more, what is going to give people the ability to pay more to push up property values? And it's really affordability, but not because properties are affordable, but because they got more money, they've got more disposable income to buy properties. And that's why we're very, very selective. And the census data breaks down every suburb and even into municipalities within the suburb. So you can, if you dig down and hunt enough, find those areas where wages growth is, as you said, 1.5, 2 times the average. Not the wages are bigger, the growth in wages is bigger. And having more disposable income will give people the ability to buy new cars, buy new TVs, but also invest in their homes, renovate homes. And we love home buyers who do that. And you're right, I love areas that are gentrifying because that's pushing things up. We like aspirational areas. And there's a lot of them still around in all our big capital cities because gentrification takes a number of decades to occur. So, Brett, the bottom line is, at the end of the day, the property statistics can help you get a better understanding of the property markets. And the statistics we're currently examining are suggesting that it's a great time to get into the market. Melbourne and Sydney had significant slumps over the last couple of years, and they've turned around. And Brisbane didn't have anywhere near those sort of slumps. It's been a much more stable market, but it's turned also. But I know that your research is showing that it's not all of Brisbane. It's definitely not all of southeast Queensland. So there's only certain segments, certain suburbs that are doing okay.
Absolutely, Michael. And, let's get back to the basics, really. It's really simple to understand. It's where the jobs are being created. And as I mentioned before, we've got a huge Queen's Wharf project in Sydney, in Brisbane, in our CBD. Our airport's getting a second runway and a huge retail and commercial precinct out there. There's 10 or 20,000 jobs per development there. We've got the Cross River Rail. There's 8 big projects which we've talked about before, and it's really all about jobs. And we've spoken before, it's time for Brisbane, but it's very difficult for that to happen when there hasn't been any jobs and people moving here to take up those jobs. But we're starting to see that change now, and I think people are starting to wake up to that as well.
Well, there's been increased interstate migration to Brisbane, increased overseas migration to Brisbane, and the demographic studies that we're doing show that when people initially move into a new state, they move because of their jobs, and where they choose to live is because of their jobs. They're not going to have a job in one suburb and live 30, 40, 50 minutes out. In Melbourne, that's a short transit, but in Brisbane, that's a long trip. And so people want to live initially close to where their jobs are, and many of them are trading backyards for courtyards or balconies, but you just got to be careful understanding the underlying demographics. Lots of interesting homework to do as a property investor. Some you should do your research yourself, and others, why not outsource it to people who are paying a lot of money, as we do, for the data and the research? Because it's actually not just the data. You actually have to understand how to interpret it, Brett.
Yeah, look, absolutely. I think we've spoken quite often before about the data, and getting that right is probably 80% of what you need. But the other 20% is equally important, and that's actually being on the ground and understanding the intricacies of the suburb and the good areas, the bad areas, and where the pockets of high demand are. And you don't get that from afar. You have to be in the market every day to understand.
Well, your team specialise in Brisbane, and if you go to metropole.com.au, you can find out all about it and organise a time to have a chat with Brett. But I know personally that even though a lot of your personal clients as a property strategist come from Brisbane, you're not purely focused on Brisbane, because you're referring those appropriately to Melbourne and also to Sydney, depending upon their budgets, depending upon where their current portfolio already is, to give a level of diversification. So if people speak to you, you're not going to just say Brisbane, Brisbane, Brisbane.
No, and the other thing I won't be saying, Michael, is property. And we all know that many people probably put the property in the area and the location before the client's needs. And we do things a little bit different here. We like to understand what the client's needs are, what their goals are, what they're hoping to achieve. And then we can start to break it down to the area, the location, and do it that way. And finally, like I said, we look at the property at the end.
Okay, well, if people want to get to know more about you, 1300 Metropole is a good number to remember, or metropole.com.au. There'll be some links in the show notes. Thanks a lot for your time, Brett.
Thanks, Michael. Good to speak.
Well, there you have it. You know a bit more about what sort of apartments to avoid. You know a bit more about research, and I told you the tale of two wolves. If you got some benefit from today's show, on every podcast app, there's a share button. Click down the bottom and please pass it on to somebody else, because my aim is to help you become a more successful property investor, more successful with money and in all areas of your life. But I'd love you to help me spread the message and let as many other people know. And I'm very impressed because our podcast statistics keep rising. We're doing very, very well, not just in Australia, but in all sorts of countries. And I particularly love it when people leave a review on the Apple Podcast app or any of the apps. And when you do, if I read it out, I'd like to say thank you by gifting you a book, any of my books. And I'm going to do that today to Tonya M from Bondi, who on the Apple Podcast app a while ago. By the way, it takes me a while to get through some of these reviews because I record these shows a little bit in advance, and I'm getting so many of these reviews, so please be patient. But when I read out your review, if you email me, michael@metropole.com.au, I'd love to give you a book. And Tonya M from Bondi said, great knowledge and realistic, broad range of topics, and shows a good range of thought on the approach to property and money. Easy to absorb insights and different points of view to explore. Great to hear. Well, thank you for those kind words, Tonya. And I'm going to try to continue to inform, educate, entertain a little bit twice a week on the Michael Yardney podcast. And in between, every day you're going to be able to get information by subscribing to my Property Update app. You can get the app at my Property Update website, or you can just get the normal email newsletter every morning as well. By the way, regularly we put out videos on YouTube, so go to Michael Yardney, do a search on YouTube, and you can get lots of great information there as well. In the meantime, I'll be back real soon because I bring you these podcasts twice a week. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?